How you doing, guys? This is Jay McMakin with Military Mortgage Bootcamp. I'm going to be your senior instructor today, and we got a lot to cover. We're going to break this down in modules for you, like my partner Fish told you, so it's going to be conducive for you at your leisure, so you don't have to sit here for the whole entire time. You can do this in a timely fashion that fits your schedule. So let's talk about Military Mortgage Bootcamp. What are we? Well, we are a school that consults loan officers and real estate agents on how to properly do VA home loans and really how to surf through VA red tape. If there's anything you're going to take away from this course today, it is to know how to surf through VA red tape by being knowledgeable, and you're going to be empowered to hit the streets to overcome some objections from the real estate community as loan officers. So this is myself, Jay McMakin, and my partner Michael Fisher, and we call him Facebook Fish. He is a social media genius, and I can say that with a straight face because he really is. It doesn't matter what our titles are because we hold a ton of them. But let's just put it this way. We've both been in the mortgage industry for 18 years. Myself, I decided that as a Marine, I'm a Marine Corps veteran. I served honorably with 1st Battalion, 3rd Marines. Hoorah, a lot of dogs that are out there. And as I came into the mortgage industry, I kept finding the same roadblocks over and over. Every time I had a veteran borrower that was more than qualified to go conventional, but we chose to take them VA because it's mathematically superior to all other products that are out there 98% of the time. What I kept finding was that listing agents, not the sellers, because sellers have no idea about VA home loans. It's the listing agent that has the perception that they're hard to do, the seller has to cover fees. All these myths that surround the VA home loan were causing them to reject the veteran's offer simply because they wanted to use their VA home loan benefit. And this typically occurs when there's a multi-offer situation. You got 3 or 4 bids, 3 or 4 offers in on a particular property, and the rest of them are 20% down conventional. It's because of the stereotype that surround the VA home loan in the past. That is what caused listing agents to immediately just kick that out. So let's kind of jump in. I am a Marine. This is me as a young Lance Corporal here, and these are some hard-looking devil dogs. These are my brothers, right? These guys look like they deserve a home to me. You want to know why? Because every single veteran that is out there in the United States did the same thing. We all raised our right hand, and we took an oath to this country to protect it from all enemies, foreign and domestic. And if ever asked or ordered to do so, we would lay down our life or be captured for it so that you all could be free. Now, think about that. So that everybody could be free. We live in a free country where you can speak your mind. That is your right to be a millennial, okay? And say whatever you want to say. And I'm not picking on millennials, I'm just saying that happens to come out a lot. So because you are in a free country, you get to be a real estate agent. You get to be a loan officer and make a lot of money. That crap doesn't happen over in the Middle East, just so you know. All right, so unless you want those guys coming over here and stomping on our soil, we need military veterans to do that. So we're gonna overcome some things today that you hear from real estate agents, okay? First of all, I wanna let you know our company core value is always do what is best for the veteran. Everything else will fall in line. This backs up the mission from President Lincoln, and that's really where the spirit of the VA was born. Although it was put into effect in 1944 from President Roosevelt, it comes from President Lincoln. And the mission of the Department of Veteran Affairs is to fulfill President Lincoln's promise. It wasn't a suggestion, a promise to care for him who shall have borne the battle and for his widow and his orphan by serving the men and women who are America's veterans. Remember, women are soldiers and Marines. They are warriors. They get shot and killed in combat just like men in today's service. So let's treat them as such, okay? 3 mandatory questions. So from today forward, I want to retrain your brains whenever you come across a potential lead to ask these 3 mandatory questions. Number 1, are you or your spouse a veteran? There's 2 reasons you want to ask, are you or your spouse, right? Number 1, you cannot assume that the female is not the veteran. I had a very uncomfortable experience in a past life when I was originating with Wells Fargo, and I had a customer come in, and it was a couple that they were going to do a VA home loan. The wife arrived first, the husband's trailing behind 5 to 10 minutes. I come in and I said, hey, thanks for waiting. I just got here. I appreciate you guys taking the opportunity to spend time with me to go over your VA home loan option for you, and any other options that might suit you best. By the way, what branch of the service was your husband in? And thank you for his service. She goes, what makes you think I wasn't the Marine? Like right up in my face. Okay, I was like, whoa, devil dog, I get it, okay? So don't assume that the female is not the veteran, because again, women are warriors, they're soldiers and Marines, and they go out there and they are putting their life on the line just like everybody else. The second reason we are asking, are you or your spouse? Because you could possibly be talking to an unmarried surviving spouse of a military member that was either killed in action or their death is a direct result from a service-connected disability, illness, or injury, okay? Once you have identified that you are working with a veteran or an unmarried surviving spouse, the next question you need to ask, are you entitled to disability from the VA? Not are you handicapped, not are you disabled, are you entitled to disability from the VA? If a military member or veteran is getting rated at least 10% from the VA, it will waive what's called their funding fee. We're to discuss that in detail as we go further. The most important question of all, and just because it's number 3 doesn't mean it's not number 1. Do you have your certificate of eligibility yet? The certificate of eligibility is the only verifiable proof that a veteran is eligible for a VA home loan. You should never, ever, 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 ever send a VA home loan to underwriting without having this document. There are 2 components to a VA home loan. Number 1 is eligibility. You are eligible for a VA home loan based on your time in service. Number 2 is qualification. Although you may be eligible because you served enough, you still have to qualify with your credit and your income. So let's look at the opportunity that's out there available for loan officers and realtors. If you didn't know, first of all, the military is the largest employer in the United States. There's over 3.1 million employees worldwide. Now, there's over $181 trillion in purchasing power. For those of you that don't know what purchase power is, it's when you take a group of society, a demographic group of people, such as Hispanics, African Americans, veterans is a group as well. And then what they're going to do is calculate their net worth and add it up. And then they report that to Wall Street. Now, when you have $181 trillion, that's a lot of money that could be spent out in the consumer markets. So this is important to companies like Macy on Black Friday and Cyber Monday, because they can buy stuff. And if they can buy stuff, that means they can also buy a house. So let's take a look at this. In 2017, so fiscal year, just so you know, the government's fiscal year is October to October. And in fiscal year 2017, there were 740,388 transactions for VA home loans, okay? Veteran home ownership exceeds the national average by 10%. Now, most of you probably know a veteran or maybe a veteran yourself. Either way, think about what military members go through. How do they live? Most of their belongings are in a pack, and you move every 6 to 12, 18 months. Even if you only stay in for 4 years, that crap gets old real fast moving around. Now, I get that everybody would prefer to buy a home rather than rent. But with veterans, it's a little bit more to the top of their bucket list because they're tired of moving around. They want to ingrain themselves and grow some roots in the community and get into their home so that they don't have to keep moving around. Now, if you are near a military base, active duty military personnel have a tendency to move every 2 to 5 years, so that could create residual income for you and repeat business. Career service members that do move around, you would think that I have to be near this base, but I'm going to show you later on why that's not that important, okay? So keep that in mind. There are 21 million veterans in the United States. About 13 million of them have seen wartime or conflict. That's approximately 62%. So this kind of goes back to question number 2, are you entitled to disability? So chances are if somebody has been deployed, they are going to rate disability. They're giving out 10% of the VA just for hearing loss, like it's going out of style, okay? So always ask that question, are you entitled to disability? Now, down here I have the states that have over 1 million veterans: California, Florida, and Texas. Those are the top 3 states, not only for veteran population, but also for VA home loan transactions. So take a look at this though. Let's take a look at something like Texas, okay? There's 1.6 million veterans in Texas. Now, here in Michigan, which is where we're from at Military Mortgage Bootcamp, we have 700,000 veterans. That's almost exactly half, just about. So if you look at the size of here, you don't these 3 states, California, Florida, and Texas, have a lot of military bases. So I hear a lot of loan officers say, Jay, that's great. I would love to help veterans out, except for the fact I'm not near a base. You don't need to be near a base, because I got news for you. There's very patriotic towns and cities all across this country where patriotic people join the military, they leave, and then they come back home from where their roots are. That's where they buy their homes, all right? And when you're talking about a state like Michigan, for example, when we have half the amount of veterans in Texas, but we're 1/5 the size. Don't tell me this business isn't here. Open your eyeballs and start looking for it and start asking these 3 questions, okay? Now, let's kind of jump into the myths. If there's anything that I want to teach you guys throughout this course is don't worry about knowing everything about VA and what you can do, because it's more important to know what you cannot do, okay? There's so many things you can do, but there's only, the same 5 or 6 things that you can't do. And a lot of times this is what creates a myth or something, a perception of what used to happen 20 years ago, 10 years ago with the VA. But things have changed. As about 5 years ago in underwriting, when it comes to VA, in the loan side of the VA, they only hired veterans. And so you couldn't be a civilian working for them. Now they have flipped that back to civilians working at the VA again on the mortgage side. However, there's enough veterans over there. I'd say 90% of the staff is veterans themselves. So now you have veterans looking out for other veterans. So cutting the red tape became kind of like a sport to them. Like, why are we impeding our people from purchasing a home over a silly little crack in the driveway? I mean, as long as it's not a 4-inch trip hazard and it's not up for the safety issue, let's just slap some Quikrete on it and move forward, okay? So we're gonna go over these myths. Here's the top 6 myths that we come across weekly in Military Mortgage Bootcamp and in the real estate community when you're trying to get your offer accepted for your veteran buyer. Number 1, 0 down equals weak buyer. Number 2, VA loans are harder to get through underwriting. Number 3, VA loans take longer to close. Number 4, the seller has to pay for the veteran's fees. That's a big one, we hear that all the time. Number 5, you can only have 1 VA home loan. This typically comes from the veteran buyer themselves, more so like the Vietnam era, and I'll tell you exactly why when we get to that bullet point. And number 6, the most and biggest, baddest killer of VA home loans, the VA appraisals are tougher. So we're gonna debunk all these myths. Let's start with number 1, 0 down equals weak buyer. Well, this is false. They're not a weak buyer. In fiscal year 2017, the median FICO score for a veteran was 741. Median liquid assets, 1732. Median household income, 73,769. Average loan amount, 259,687. And contrary to popular belief, 29% of veterans in fiscal year 2017 actually made a down payment. Just because you're entitled to go 0 down, the veteran has earned that right, that benefit to go 0 down because they were willing to lay their life down or be captured for this country. But they make a lot of money, and just because you're a military member doesn't mean you're broke, or that you're not smart, or that you don't want a lower principal balance. 29% of them put a down payment down. So let's take a look at this VA buyer of 2017. When we say veteran or military, this is exactly what people think. They see the image on the right, the gentleman who's dressed up in his camouflage. Well, I can't blame them. That's what we see on TV every single day. So those of you that don't know, this country has been at war, or considered war, since August 2nd of 1990. That is 27 and a half years so far. And in August of 2018, it'll be 28 years. So people that are watching who are under the age of 30, pretty much your whole entire life, when you turn on the TV, this is what you see. But I want to change your perception to the image on the left, the suit and tie. Veterans are very successful people, and they make more money than civilians on average, and there's stats to back it up. Let's take a look. Remember when I said you don't need to be near a military base? It's because you don't. Because 83% of veterans that actually use the VA home loan benefit don't use it until after active duty, okay? Now, 29% of veterans that are 25 years and older carry a bachelor's degree versus 29% of the total population. So this is dead even with civilians. This statistic has grown enormously since the Vietnam era, okay? Now, it used to be if you didn't go to college, you went to the military, and maybe that's a little bit true today. So let's say you don't go to college, you don't get a football scholarship or anything like that. Next thing you know, you're over in the Middle East, and you're in the desert. It's 125 during the day, it's 38 at night. You got staying in places you don't want to talk about, eat crap food out of a box, getting shot, right? Pretty much wish I was sitting in class with my buddies back home. So if I ever get out of here alive, that's exactly what I'm going to do, and I'm going to take advantage of my GI Bill. So let's say I do 4 years, I come home, and I go to, let's say, Michigan State, because we're from Michigan, and I get myself an engineering degree. Right about now, I'm probably about 26 years old, and as a 26-year-old engineer degree combat veteran, I go for an interview with General Motors or Ford or Chrysler, and I'm up against a 24-year-old, same degree from Michigan State engineer. Who do you think is going to get the job? It's going to be the veteran, hands down. And I believe there's a couple of reasons why. So first of all, let's take a look at this first. The median household income for veterans nationwide is $73,769. The median household income for the United States as of 2018 is $55,775. So veterans on average make $18,000 more a year. And the reason why I believe that happens is because if you look at the left side of the screen, the suit and tie, this person tends to rise to management quicker. They are disciplined. They don't fail. Mission accomplishment. They don't need to be micromanaged. They don't have entitlement issues. They are just happy to be home, happy to be alive, working for General Motors. Okay? There's 10.1 million U.S. veterans with a service-connected disability rating across the country. So, and this is growing more and more. So if you come across a veteran that has not filed for their disability, please encourage them. Now, my partner Fish will tell you, if you ever ask him, I sit here and preach this all day long to people, but it wasn't until, what, a year ago or a year and a half ago that I actually filed for my own and got everything. Because I felt like I was, I wasn't handicapped, I could still function, and that money should be put to use for other veterans that need it more. That is horse pucky, as they say in Texas, right? And I'm not sure if that's Texas, but it's somewhere in the South, horse pucky. Either way, I had a Vietnam vet come up to me in the VA hospital. I was actually there doing a VA mortgage class. And he asked me, did you file for your disability yet? And I said, no, I feel like it should be put to better use for people who need it more. And he said, let me tell you something. When you don't file for your disability, you are screwing every veteran in the United States. I was like, what? Think about it. And this is what he told me. The government has dollars that has to go out in a budget, and the squeaky wheel gets the grease. If veterans don't squeak for their money, for their disability, that money gets to go other places like baby mamas and food stamps and people who are coming into this country and put them on welfare and all kinds of things for 7 years. So encourage your veteran to squeak for their disability. They earned it. Next, okay, so zero down, weak buyer. We know that's not true because what? This person right here, look at this profile. They could go conventional any day of the week, but why would you put more money down to have a higher interest rate and a higher monthly payment? That makes no mathematical sense. So zero down equals weak buyer is busted. That myth is busted. Let's go to number 2. VA loans are harder to get through underwriting. Well, again, I beg to differ. Now, this statement right here is listed exactly as it is written in the VA pamphlet 26-7. For those of you that don't know, the 26-7 is the lender handbook that every lender in this nation uses to write and underwrite, VA home loans. What I'd like you to do right now is take a quick second to go and Google it, the VA 26-7, okay? And don't click the URL that has Veterans United Home Loans. Make sure it says va.gov at the bottom. And I want you to save that to your favorites bar so that you can start living in the VA 26-7. This is the law. This is the Bible of VA, okay? The law is the law is the law. However, interpretation of the law could win or lose you your case with the judge being the underwriter. Now, just like the Bible, you have to live in it to understand it, okay? You can't be a pastor of a church, read the Bible one time, and then go preach to a congregation for 20 years. It doesn't work that way, okay? Why would it be any different when you're trying to be a specialist? Know your trade, be a master of your craft. Now, Bill White, who was there when this book was written, says as long as lenders document their reasoning, it is extremely unlikely the VA staff will ever take issue with their decision. Now, what is he talking about? They're talking about this statement right here that is in the 26-7. Underwriters are encouraged to consider every possible appropriate factor in seeking a proper basis for approving loan apps for every qualified veteran. Not every veteran, every qualified veteran. Remember, two components, eligibility and qualification. Now, let's take a look at this. Why do lenders want to do VA home loans more than conventional or FHA? There's three distinct reasons what lenders really look at and why they want to do a loan product. First and foremost, when you're a lender, you want to know what your portfolio performance is doing versus your default ratio. So default ratio is a really big concern to lenders. And just so you know, for the past 12 years straight, VA has had the lowest default ratio in the nation. Less than 2% of veterans ever go to foreclosure. It's actually 1.98. Conventional is 2.1, which is pretty good, and FHA is poor at 4.30. So if I'm a lender, I have a 98% chance that this veteran borrower is going to make their payment. But what happens if they don't? That's the next thing you look at as a lender, is what is my protection against borrower default? Well, Fannie Mae and Freddie Mac, which are the investors that govern all conventional home loans, guess how much they pay out to a lender if the borrower forecloses? Donut hole, nothing. Do you want to know why? Because you weren't supposed to foreclose. You had an 805 FICO score. You put 25% down. Your DTI was 18/21. You were allegedly the best borrower out there, okay? But we're going to see what happened to that. Ginnie Mae is the investor that governs FHA and VA. And just so you know, FHA and VA are insurance agencies. They are not investors. They are not lenders. They are like State Farm and Allstate, paying out claims to lenders who pay for insurance. With FHA, you literally as a lender, if the borrower defaults, you have to submit a claim to a claims adjuster. The claims adjuster will either approve that claim or deny it. Now, I always say in class, you got a 50-50 chance. But if you want to sit down with a group of individuals who work in the secondary for lenders, they will tell you, 50-50 my butt, right? It's more like 30-70 that they ever pay out. VA is the only one that guarantees a lender in the event of a foreclosure, they will do two things, two checks. Number one, they clear the loan off their line. Number two, they cut them a check for 25% of the loan amount with a minimal payout of $36,000 in most cases. So let's take a look at this. Now I have a 98% chance the veteran borrower is going to make their payment. If not, either in the 2% category, you're telling me it's guaranteed, no questions asked, you're going to buy this loan off my books, plus cut me a check for 25% of the loan amount, that's a pretty safe investment. So why is it a little bit more difficult over here for Fannie and Freddie? Let's kind of jump ahead to the next slide. Here's what's called lender overlays, all right? This black line down here represents the minimum investor requirements, okay? So all lenders, whether you're Wells Fargo or you're Ross Mortgage or you're some regional lender or Benchmark Mortgage or you're, whoever you are, these investors say you need W-2s, pay stubs, you need title, clear title, you need bank statements, blah, 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 right on down the line. A lender cannot take away from those requirements. However, it is their money, and he who holds the gold makes the rules. They have every right in the world to add extra layers of risk protection against their potential investment. And you can see conventional has the most overlays that are out there. Why? It goes back to this with Fannie and Freddie. If you foreclose, Fannie and Freddie pay me nothing on a conventional loan because you were a conventional borrower that was not supposed to foreclose. But these overlays are happening for a reason. Every overlay that is out there, as a matter of fact, every guideline that is out there is there for one reason, because the bank or the lender got burnt by it, okay? And we had an epidemic in this country when we had the mortgage meltdown with conventional borrowers who decided to throw their keys back and buy the house down the street prior to throwing their keys back because they were able to qualify for 2 loans at once, and then they ditched the other house. It's called a buy and bail. So underwriting is more than just the ability to pay back a loan. It is your ability plus your willingness. And when you're a conventional borrower with Fannie and Freddie, although you have the ability to pay back the loan, if you don't have the willingness and you tell me pound sand, you are more dangerous to me as an investor than actually FHA and certainly VA. VA borrower who might not look as strong on paper because they don't have that 750 FICO score and they might only have a 680 and their DTI is right near the threshold and they may not have all the reserves. It doesn't matter because you want to know why? The proof is in the pudding. Veterans make their freaking house payment. If anything's going to go late, it's going to be a car. It's going to be a credit card. They do not pay their house payment late, and there's absolute proof of that. So this is why there are so many overlays when it comes to conventional. FHA doesn't have as many overlays because, again, there is a possible payout to the lender. So if I'm a lender, I don't have to protect myself or make myself bulletproof the way I need to with conventional. VA has the least amount of overlays that are out there. Now, let's look at number 3. So we know right now I got a 98% chance as a lender. If I lend to a veteran, they're going to make their payment. 2% chance if they default. You are guaranteeing me that you're going to clear my line of that loan and you're going to give me a 25% payout. But let's look at the third thing, public image. Now, most of you hopefully remember that back a few years ago, between 2007 and 2009, that a term came out called rubber stamping. This literally came from VA home loans because VA borrowers were off fighting for our country in Iraq and Afghanistan, and they were getting foreclosed on where they were fighting for our country. That is an absolute no-no, and it violates the SICRA and the Sailors and Soldiers Act. See, with those two acts, when you are off fighting for our country, it's like a pause button on your credit. They cannot mark you late. They cannot mark you on time. It's just frozen in time. So what was happening is the country's having a mortgage meltdown. Nobody's ever seen anything like this before as far as lenders are, period. But lenders certainly didn't have enough staff. So you have all of these loans defaulting and they're just stamping foreclosed. That's where the term rubber stamping comes from. Instead of taking the time to take this file and go, oh, here's a VA loan. Let me set this one over here because they're protected by the Sailors and Soldiers Act and the SICRA Act. Well, that didn't go over very well in the media. And huge lenders, the top 3 specifically, right, when you're the biggest, you have the biggest target on you. They were massacred in the media, okay? And when you were a JP Morgan Chase or a Wells Fargo, what happens when you get massacred in the media? Your stock goes right on down. And you cannot afford to have that happen very long. So they rectified the situation. Wells Fargo, we're giving away to Homes for Heroes, our Homes Free Clear. We're taking those people that we accidentally wronged and we're fixing them and reducing their principal or wiping it clean. Those are awesome things. They should have done that. That's great. Chase, we're hiring 100,000 veterans. We love them. Okay, Bank of America, if you purchase our REO properties on our foreclosures and you're a veteran or a family member, we'll give you a 20% gift of equity. Those are all the forms of payback for their violations that they committed to those constitutional rights to veterans. So, in recap, right here, this is such a win-win-win for a lender because number 1, I got a 98% chance this veteran makes their payment. Number 2, if they don't, it's a guarantee that I'm reimbursed plus you clear the loan off my line. And number 3, public image. We look like heroes for putting veterans in homes. What I'm getting at, guys, is there isn't a lender today that wants to be the one to decline a VA home loan. And they are going to work extra hard to put veterans in homes, way more so than conventional, where they're like, dude, you better be bulletproof because there's a piece of lint on this sucker. They're kicking it right out of the portfolio. So that myth is busted, that VA home loans are harder to get through underwriting. They are actually the easiest loan to get through underwriting as of today's mortgage world. Let's jump into number 3. VA loans take longer to close. This is just absolutely false, flat out. 99% of all VA home loans are underwritten by lenders with automatic underwriting authority. This means that they can use the DU system, they can get the approved eligible that's out there, and they can move things very quickly. The average turn time from application to close in fiscal year 2017 was 26 days. If that is not an acceptable time frame for any real estate agent that you work with, let me give you a piece of advice. Fire them! All right. That myth busted. The seller has to pay for the veteran's fees. This is like a real common one that we hear from the real estate community. And it's absolutely false, but there is some sort of truth to why they think that. So let's jump into this. This comes from the unallowable and allowable fees section in the 26-7. The following fees are not allowed for a veteran to pay. A lender appraisal, meaning that the lender wants a second appraisal. The veteran can only pay for one appraisal. Number 2, lender inspection. Settlement, escrow, closing fee, doc prep fee, underwriting, processing, application, pest inspection, that's your termite. Attorney fee, assignment, copy, email fee. All these fees cannot be paid by a veteran only if there is a 1% origination being charged. Now, think about it. Historically, what have lenders charged borrowers? Always 1%. Now, in most recent years, you don't have that. And there's plenty of lenders today that don't charge an origination to a veteran, period, okay? So where this myth comes from is that lenders used to charge a 1% origination. That now means the veteran cannot pay these fees, okay? So if that happened, the first line of defense that the veteran would do is they would go to their lender and say, hey, I can't pay these fees, can you pay them? Who's gonna pay these fees? The lender would say, sorry, I'm charging you an origination fee. I'm already giving you a great rate. I don't have any money on the back to help you with. So you move up the chain of command as far as the transaction is concerned, and they go to the real estate buyer's agent, the buyer agent for the veteran, who in most scenarios, let's just face facts, they're not closing 3-4 loans a month. They close one home every couple of months because they're a buyer's agent, new to the industry, part-time, whatever the deal may be, right? So chances of that agent giving up their commission, slim. So let's go to the next step. Who is the next person in the transaction? The listing agent? Are you really going to roll up on the listing agent and ask them, who works for the seller, to cover your veteran buyer's fees? That conversation's never even happened. So who gets stuck is the seller. Now you're already far enough along in the transaction, they don't want to restart everything, and they don't want to go through this process. And that's how this stereotype was created, this myth was created. But this is false. Never, ever, ever, since 1944 when it was created, has a seller ever had to pay for the veteran's fees. Why would they? It is the veteran's loan. So here's the correct answer. If there is a 1% origination fee, okay, none of these fees can be paid by the veteran. It doesn't say the seller has to. It just says the veteran cannot. So, there's 2 things that you can do. Now, here in Michigan, the 2 fees you're going to come across are, number 1 is the closing fee for title, and number 2, the termite. So let's discuss the closing fee. Work with a title company that wants to work with veterans. Almost every title company I talk to is willing to waive this fee for a veteran. And by the way, they can write it off as a charitable donation to veterans at the end of their tax year as well. First of all, it's not going to ding their P&L that much because they're not going to be closing that many. All the veterans in all the world are closing with that title company that's going to hurt their P&L, okay? So this is a pretty simple fix. If you don't have a title company that's willing to do that, find one. All right, pest inspection. Every borrower nowadays gets a home inspection. It's usually $350-ish, right? To add a termite to that, another $100-ish. So you're sitting around $450-ish, okay? What's acceptable by the VA is that in the line item for pest inspection, because it's broken down by line items, okay? If the line item for pest inspection says $0, that's totally acceptable. You can still charge $450 for the whole entire inspection. Just move it up to admin or labor costs. Just make sure that line item for termite says 0. And quite honestly, most home inspectors are veterans. I don't know why, but they are, okay? And most of them will waive the termite just because it's another veteran, or they want to be friendly to veterans if they're not a veteran themselves. So let's say there is no origination fee. That means the veteran can pay every single one of these fees themselves, including the termite, up to 1%. So this is a myth that has really inhibited a lot of offers from being accepted throughout the years, but no more. This doesn't have to happen ever again when you properly know how to tackle this issue. So, myth busted. The seller has never had to pay for a veteran's fees. Now, let's get into number 5. You can only have one VA home loan at a time. Like I said, this typically you'll hear from the veteran borrower themselves, and typically Vietnam era. Okay, let's discuss entitlement, because this is really where this myth comes from. Now, entitlement is the backbone of the VA home loan. So guys, if you can understand this and grasp this formula and this concept of how to calculate it, you will be 95% smarter of all loan officers in the country when it comes to VA home loans. And quite honestly, about 50% of the underwriters. It is alarming to me how many VA underwriters out there do not know what they're doing for VA home loans, and they're a VA underwriter. And the reason for that isn't because they suck, it's just they were trained with an FHA brain, and it's very hard for them to put that VA hat on after FHA. So let's dive into entitlement. Just generally speaking, entitlement is 25% of the max loan guarantee. No, I didn't say max loan amount, max loan guarantee, and I'll cover that in just a few slides. So yes, technically, you can get higher than a 25% entitlement. You can get up to 50%, but that's if your loan amount is so low, it's like $49,000 and below. So most of the time, 99% of the time, your entitlement is always going to be 25%. So as a rule of thumb, that's what we're going to use for this course, okay? Now, the 3 biggest myths that surround the entitlement calculation are as follows. Number 1, you can only have one VA home loan at a time. Number 2, if you foreclose on a VA loan, you can never have another one. And number 3, the VA has a max loan amount. So let's kind of dive into this. Where do these myths come from? Well, the first 2 come from your entitlement category. So first, you have to know every veteran has 2 sets of entitlement. There's basic entitlement and bonus entitlement. Basic entitlement is if your loan amount is from 0 to $144,000. Bonus entitlement is from $144,001 up to the county maximum, which in 95% of the counties across the country is $453,100. Now, I know some of you live in high balance counties. Well, God bless you. The rest of us don't. So we're going to use this as a calculation, okay? For those of you rich people, you're just going to have to play along like you're not, all right? So basic entitlement is where these 2 myths were born from. That you can only have one VA home loan at a time, and if you foreclose on a VA loan, you can't have another one. The reason for that being is because prior to the mid-1980s, bonus did not exist. There was only basic entitlement. So this statement was true, that if you had a VA home loan out, you couldn't have another one at the same time until this one was paid off. And if you foreclosed on it, you couldn't get another one unless you paid the VA back their entitlement, which you can imagine how often that actually happened. So along comes the mid-1980s, and the VA rolled out bonus entitlement, because if you had a property and you bought your first home as a veteran, and now your family increased, and now you need a 3 or 4 bedroom property, and you decided that this one here, we're going to keep this property and rent it out, or we're moving from states and this hasn't sold yet. At that point in time in history, bonus didn't exist yet. And so what had to happen was they were forced to go conventional or FHA. And the VA said, well, why are we doing that to our people? Why don't we give them another option? And they created bonus entitlement. Same thing if you actually foreclosed. Hey, you know what? They made a mistake. Let's give them another chance. So can you have a loan out in basic entitlement and have another VA home loan? Sure, but it has to be over 144. 144.01 up to the county max. Now, remember, 25% is our figure that we're using. 25% of the max loan guarantee is your entitlement. So in basic entitlement, if the max loan amount in basic entitlement is 144, 25% of that is $36,000. This is why on a certificate of eligibility, it says maximum, it says you have full basic entitlement, which is $36,000, right? The reason you don't see bonus entitlement on a certificate of eligibility is because it varies all over with the counties with their maximums, right? Because there are some high balance counties out there, and it would be too hard because the government likes one form, right? They want to keep everything on one form. So they're safe with basic entitlement. They know absolutely that every county in the United States in up to 144 is going to be $36,000. So Let's take a look at this. Here's how I'm going to teach you how to do entitlement calculation today. We're going to treat it like a checking account, okay? So when you have a checking account, you have a beginning balance. Now remember, the county maximum loan guarantee is $453,100, and we're using 25% of that to get our entitlement. So 25% of $453,100 is $113,275. That is going to be our beginning balance in our entitlement checking account. So let's say I'm a young Marine and I'm in North Carolina and I decide to purchase a home for $144,000. $144,000 is the loan that's going to get guaranteed. Find the entitlement, we take 25% of that. 25% of 144 is $36,000. So that means I need to make a withdrawal from my entitlement checking account. When I subtract $36,000 from $113,275, I'm left with a balance of $77,275. Now, to find your max loan amount after you have a loan, you're always going to use this formula. You take remaining entitlement times 4. So I could have a loan out in North Carolina for $144, and I want to come back home to Michigan, right? So there's two things that are going to happen. Now I'm getting out of the military, let's say, and I have this house for $144,000. I have a choice to make. I can either A, sell that house and pay it off, which would put my entitlement right back to $113,275. Or B, I could keep this as an investment property. Let's face facts. It's a mile outside of base. Somebody's going to rent this property. So I decide to choose and say, hey, I want to keep it as an investment property. All right, that means I still have this $36,000 out, and my balance in reality is $77,275. So I want to come back to Michigan, and I want to buy a home back here, and I want to use my VA home loan benefit again and go zero down. I take my remaining entitlement, $77,275, multiply times 4, and I come up with $309,100. That's as high as I could go, zero down. Notice I say zero down. So let's go to the next slide. Let's do another calculation, another word problem here. We have a $130,000 loan. Let's say I buy a house in Georgia. 25% of 130 is $32,500. Now remember, my max entitlement and basic entitlement is $36,000. Once I subtract the $32,500, I have $3,500 remaining in basic entitlement. Now I haven't used any of my bonus entitlement yet, so we're going to add these two together and come up with a total of $80,775. You take that figure, multiply times 4, and I can go up to $323,100. Zero down. So what if my purchase price happens to be $423,100? Okay? If the VA is only going to guarantee up to $323,100, I have a $100,000 gap that I'm short to close. If you were doing conventional or FHA or RD or jumbo and you're short 100 grand, you're bringing 100 grand to close. End of story. Not with VA. The VA says the veteran only has to pay 25% of the difference between the purchase price and the max loan guarantee. So in this scenario, when the difference is $100,000, my veteran buyer only has to bring $25,000 to close, which by the way can be a gift, because all funds to close on VA home loans can be a gift, guys. But what happens to this other 75%? Okay, 75% of 100 is $75,000. That's got to go somewhere. Well, we're going to roll it into the $323,100 that the VA was guaranteeing me max, zero down. So this is going to take $323,100 plus $75,000. I come up with a total loan amount of $398,100, and I'm only out of pocket $25,000. Now, yes, the veteran buyer has to qualify for the higher loan amount of $398,100, but there is no other mortgage product that allows a borrower to do that when you are short to close. So let's talk about number 3, that the VA actually has a max loan amount. Here's what happens when we just did a calculation where we exceeded the max loan guarantee. So when you're exceeding the max entitlement on a purchase, here's what has to happen. First of all, understand the lender can lend whatever they want. It's their freaking money, okay? The VA cannot compel a lender to lend its money. So a lender can lend whatever they want, but if they want the VA to guarantee that loan so that if the borrower forecloses, the VA will buy the loan off their books and pay them 25% of the loan amount, they have to carry 25% coverage, okay? So let's say a lender wants to do $1 million loan, Okay, they want to do $1 million purchase. Now, on $1 million purchase, we need 25% coverage. So 25% of $1 million is $250,000. Of that $250,000 we need, we know the VA is going to contribute $113,275 because I have full entitlement, and that's my beginning balance of my checking account. Once I subtract the $113,275, all that's left over is $136,725 due from the borrower at close. Now, put your hats on. Loan officers, $1 million category. That means you're in a jumbo category. And as a general rule on jumbo, you put 20% down. 20% down of $1 million is $200,000. When I subtract that, I have $63,725 left in my pocket going VA. Not to mention my rate is a half a point lower. Not to mention I don't need 9 to 12 months reserves sourced in season, which would leave me with a loan amount of $863,725. Awesome, awesome product. There's no other product that allows you to do that. VA wins again. Okay? So let's jump into the funding fee. We've talked about this funding fee. So we go right back to the beginning with question number 2. Are you entitled to disability from the VA? If you get 10% or more, this funding fee goes bye-bye, right? Well, let's take a look at what is charged. So first time use and subsequent use. First time use, if you go 0 down on a VA home loan, you have to have a premium paid. The funding fee is what actually funds the reimbursement of the lender when the VA guarantees if you default. Okay? The good news is veterans hardly ever default. And here's a piece of useless information. The VA funding fee is the only freaking line item in the United States government's budget that is in the black. Real talk. Look it up. So much so that the government borrowed from this. The Senate borrowed from this. That should offend every veteran you've ever met in your life. But don't get me started. Now, 0 down. You're 2.15% on a first time use. However, we know 29% of veterans actually need a down payment. Why? Because if you don't have disability and you put money down, it decreases the interest rate on the funding fee. If you put 5% down, it goes to 1.5%. 10% or more goes to 1.25%. So let's look at subsequent use. Every VA loan you have afterwards, if you go 0 down, look how high this jumps. It jumps to 3.30%. Okay, 3.3% on a $300,000 loan. That's 10 grand. That's $9,900. That's a lot of freaking money. This is the VA's way of incentivizing the veteran. Hey, put some money down. First time, I get it. You were a first-time home buyer, or to cut you a break. But now you're, 50 years old. You've done 3 loans. This is your 4th house. Put some money down. Because notice, whether you're first-time use or subsequent use, once you put money down, this does not change. 5% down is 1.5. 10% or more, 1.25. Now, reservists, their interest rate happens to be a bit higher, is 0.25% higher. Okay. Now, since we're dealing with loan officers, I will discuss refinances here. So, cash out refi. The only time you're going to get first time use of 2.15% is if the veteran borrower literally never had a VA home loan and they are currently in conventional, currently in FHA, jumbo, RD, and you are taking them out of that loan product and putting them in the VA. That is the only way you're getting 2.15%. If you already have an existing VA home loan and you want to pull cash out, always 3.3. Ding, 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 right? Now, again, very important to ask, are you entitled to disability? So, when you ask, are you entitled to disability from the VA, you may hear something like this. Not yet, but I filed my claim. This is extremely important. Write this down, okay? When a veteran buyer or borrower does a VA home loan, as long as that disability claim is filed prior to the closing date, they are entitled to a refund. So this loan closes and they're in process for disability rating, it just didn't happen fast enough. Once they get approved, they are entitled to a refund from the lender, okay? It will be paid back to them exactly how the VA funding fee was paid. There's 3 ways to pay it. Number 1, cash to close. Number 2, can be seller concessions. And number 3, most likely it is financed into the transaction. Now, if it was cash to close or seller concessions, then the lender will cut them a check. However, if it was financed, all they're going to do is do a principal reduction on the VA home loan. So let's talk about over here, other types of refinances and different percentages. The interest rate reduction refinance loan, ERL, okay? This has become a hot topic in our industry. This was designed as an awesome benefit to the veteran for making your mortgage payment on time. You technically don't even have to have a job, right? No income is required. No assets are required. No credit report is required. And no appraisal is required, okay? As long as you showed what's called net tangible benefit, meaning it was worth it financially, okay? There are so many lenders out there that have bastardized this process that is now almost a felony, or it will be to some lenders soon, because you are taking predatory action and advantage of not only disabled vets and veterans, senior citizen Vietnam era disabled vets, because somebody calls and says, hey, I want to do a cash out home loan, but I don't have enough equity in my home to do that. And my income is so low because all I have is VA disability, I can't ratio out in a regular refinance and a cash out. And some slick loan officer comes along and says, hey, I got a great idea. Why don't we do an interest rate reduction refinance loan for you? We'll take your rate down just a tiny little bit, and you can skip a payment, and plus you'll get your taxes and insurance impounds back. Overall, you'll get to save about, now you'll get some money back for about $6,000 to $8,000. Does that sound like a plan? Sure, you're the loan officer, you know. The churning and burning of ERLs is very predatory. Be careful not to ever sell what I just said as a benefit, because it is not. You are taking advantage of a veteran if you do that. Always do what's right for the veteran. Everything else will come in line. Now, the funding fee on an ERL is 0.5 point. Manufactured loans is 1 point. And assumptions is 0.5 point. For those of you that do not know what assumptions are, that means that you can take over my existing loan balance with my existing interest rate as long as you qualify with your credit and your income. Now, you do not have to be a veteran. A lot of people think that. That's a myth. You could be a complete stranger and do an assumption. All assumptions are underwritten by the VA directly, okay? Now, although you could be a complete stranger and do an assumption, it is a good idea to do it from one veteran to another for this reason. Let me back up, okay? We go over here to this entitlement calculation, right? Now, if I have a civilian say, hey, you know, for whatever reason, I agree to do an assumption, and they send their income and assets and their credit to the VA, and the VA underwrites it and says, yes, you're approved. They take over my loan. That debt is gone to me. It is now off my credit report, but the loan is not paid off. And since the loan is not paid off, my entitlement is still attached to it. So this certainly could affect me buying my new home in my calculations here because of the entitlement that is actually out at that point in time. Same goes for if that person who assumed my loan in the future forecloses, that my entitlement goes bye-bye. Now, same scenario. I allow a veteran to assume my VA home loan. Same thing, they send their income qualification documentation and credit documentation to the VA. The VA approves them. Now they take that loan. That debt is gone off my credit report. But because they are a veteran, their entitlement replaces my entitlement. So you do not have to be a veteran to assume a VA home loan, but it is a good idea because the debt is gone and you get all of your entitlement back. All right, so that myth is busted that you can only have one VA home loan at a time. Let's get into myth number 6 and the final big one here. Appraisals. VA appraisals are harder to do, okay? VA appraisals have 2 distinct rebuttal processes. The first one is called Tidewater. The second one is called consideration of value. So let's look at Tidewater. What's happening in Tidewater in phase 1 is the appraiser's gone out to the property and they've done the inspection, but they don't have enough information at their fingertips to reach the purchase price, okay? So what they have to do is initiate a Tidewater alert in the VA portal, okay? This isn't a suggestion. They have to do it. And just so you know, appraisers have minimum standards for turn times. They have an actual turn time that they have to meet, a deadline. Here in the state of Michigan, it's 5 business days from the time that the appraiser receives the invoice and they accept the order to the time it has to be back on the lender's desk. 5 business days, okay? If they get outside of that, we have every right in the world to chomp on their butts and get them moving. If not, it will ding their scorecard, okay? And we'll talk about this scorecard next. So let's go back to Tidewater. The appraiser has done the inspection. They can't reach the purchase price. They initiate Tidewater alert. This now means that you have 48 hours to produce 3 comparables, not 67, okay? 3 comparables that support the purchase price. Now, when working with listing agents, loan officers, and if any agents are watching this, you should laugh because it's true, right? The first thing a listing agent thinks about when an appraiser rolls up on them and says, sorry, I can't hit your purchase price, is you suck. You know nothing about my market. You were an absolute idiot, okay? Or it's just an opinion. Appraisers just have an opinion, right? Well, I got news for you, listing agents. Just an opinion, unlike your listing, right? They're both opinions. So let's stop fighting with each other and work together as allies to come to the common goal of let's get this done. Your seller sells the house and a veteran gets to move into the home. So treat them as an ally, not an adversary. Because in Tidewater, you actually, listing agent, buyer's agent, lender, have the opportunity to influence the value to get to what you want. I said that, influence the value. That is a no-no in our industry, except for VA home loans. Why can you influence the value in Tidewater? Because there is no value yet. It hasn't been put on the report just yet. So the appraiser does the Tidewater alert. Now what's going to happen is you go to phase 2. You're going to start getting 1 of 3 things happening. A, comps are going to come back that support the purchase price. Outstanding, great, everybody wins, you get your purchase price, okay? B, you get comps back that don't support it. I'm the appraiser, I asked for apples to apples comps, you sent me a pumpkin squash and a banana. I know that never happens, right? And number 3, I as the appraiser reach out and initiate Tidewater, but I get no communication or no response back whatsoever. Either way, at the end of 48 hours, I have to move on to phase 3 and I have to issue a value. Once the value is issued on the VA appraisal, Tidewater is over, done with, okay? Then what has to happen is the appraiser has to issue the appraisal back to the lender. Now, at the lender, there is a SAR. Write this down. SAR stands for Staff Appraisal Reviewer. There is a SAR at the lender, and there is a SAR at the VA. A SAR is equal rank on the collar to a VA appraiser. Okay? The SAR at the VA actually has authority of up to 15% to change back value. They can just wave their wand and put it back without even going out to the field. Okay? Now, the appraiser is going to issue that appraisal report over to the SAR at the lender. The SAR at the lender now has to issue what's called the NOV. Write that down. That's extremely important. NOV stands for Notice of Value. This is the official value given to the VA appraisal in the VA portal. Okay? That value is now attached to the property and the borrower's SOC for the next 6 months. Okay? But it's not over, guys. We still have one more chance to get value back. And this is the coolest thing about VA and a benefit to the sellers, right? You didn't win in Tidewater, okay? If you were doing conventional or FHA and your value comes in short, guess what? You could try to call the appraiser and see if they'll take your comps, but they can tell you pound sand. I don't have to listen to you, right? VA, they have to do a process, and if you fail in process number 1, now what you can do is go directly to the VA through their SAR and the SAR to lender and go over the appraiser's head and overturn their decision. So let's see how we do that. So what has to happen is the veteran themselves has to request in writing that they want the lender to initiate reconsideration of value to get value back, okay? The SAR at the lender is going to take the appraisal and they are going to go through it and try to find mistakes, okay? So let me go back up 1 second here. When you are sending over comps to try to get the value back, it's very important to know 2 things. Number 1, and write this down please. Number 1, you cannot use comps that are older than the date of the appraisal. So if your appraisal was done on the 1st, you can only use the 31st or 30th, depending on the month, and backwards, okay? Number 2, your comps have to be closer than the appraisers. I cannot tell you how many times I've had realtors come back and be like, well, I got an amazing comp that's less than a mile and it's like 0.65 away, so what? We got 3 within 4 blocks, okay? Chances are, guys, you're not going to beat the appraiser at their game or overturn it. And it's been my experience, the reason it's coming in short is because the listing agent has overlisted the property, okay? I know that never happens either. But in reality, here's where you win, is finding mistakes in the adjustments that the appraiser made on their own comps. How can they even argue? They're their comps, they selected them. I can find at least $2,000 to $7,000 of mistake on almost every single VA appraisal that's out there, okay? Not saying that's awesome and hey, great. I can find the same mistakes on conventional and FHA. So just so you know, VA appraisers are the same appraisers that are doing your conventional and FHA. It's not a VA appraisal problem, it's an appraisal problem. So get that out of your heads because that myth is about to be busted. So the SAR, the lender, will send over and ask for a specific value. So let's say our purchase price was $160 and the appraiser came in at $140. The SAR is going to say, look, I agree with this appraiser that it is not worth $160. However, I don't believe it's worth $140. I found a lot of inconsistencies in their adjustments and was able to find back some value. I think it's $150. We are officially requesting $150. Now, stop and write this down. Before that SAR sends that over to the SAR at the VA, you must have a conversation with the seller. Are you willing to come down? 160 purchase price, got cut to 140. If the VA is going to come up 10 grand, can you come down 10 grand and meet in the middle? If the answer is yes, you're going to win. But don't even send it without having that conversation. And here's why you're going to win. Because now the SAR at the lender is sending that over, that value request, to the SAR at the VA. The SAR at the VA's first question to the SAR at the lender is the seller willing to come down? Yes, we've already inoculated for that. We really feel strongly it's a 150 value. They're going to look to see if it is within their 15% tolerance to grant that value back in the first place, which between 140 and 150, it certainly is. We can do that, right? Then they're going to say, look, the seller is putting skin in the game and they're trying to help that veteran get in. We can do this. So you got to understand, the VA's biggest pet peeve is anyone or anything that is impeding the veteran from the purchase of the home. And that includes appraisers that are devaluing that are out there. They don't care about the seller. They don't care about the agents. They don't care about the lender. They care about that veteran and they want to protect them and make sure that they're not buying something for more than what it's worth. So we can absolutely give the listing side a better chance. Not that they should need it if they list it properly, but in case they don't, this is the best option for them to accept the offer freaking anyway. Screw conventional FHA. Now, here is the VA scorecard. We were talking about this, that it's no longer a VA appraisal problem. Fannie Mae and Freddie Mac actually went to VA and used their risk parameters in CoreLogic. For those of you that don't know what CoreLogic is, it is the data system that, it's an electronic appraisal system, holds a ton of data for all conventional FHA, VA now, every type of appraisal that's out there, way more than the MLS, okay? And basically, Fannie and Freddie said, why are your homes upside down so much? Or ours are upside down so much and yours are not. You're either break even or have some equity. And the time period that I'm talking about was when the country had the mortgage meltdown. Okay, here in Michigan, houses were upside down almost 150%, not the VA ones. They were either right at break even or had a little bit of equity still. And Fannie and Freddie are asking VA, well, why? And VA promptly responded and said, well, because we followed the rules. Your comps don't exceed 1 mile radius. What do you guys use? 1 mile radius, just so you know, Fannie, Freddie, FHA, 1 mile radius. But the problem is, they were letting them go 1.67, 2.5, 3.12, because It supported the market. All that did was create a big freaking bubble that popped, right? And to be quite honest, I see some alarming signs, the same thing going on in our industry right now. So, there is your myth busted on BA appraisals that are harder to do, because guess what? All appraisals have the same format. It is a level playing field. The only difference between a conventional appraisal and a government, meaning FHA and BA, is the freaking lead-based paint. Because some numbnuts, like Tommy Boy, ate some paint chips in 1978. We're gonna have to live with that for the rest of our lives. This section is over. Time for your quiz.